This video is for educational purposes only and is not financial advice. Always do your own research before investing. If you've spent any time in European personal finance forums, you've heard the same advice on repeat. Stop picking stocks, buy one global ETF and get on with your life. Fine advice. But which fund actually earns that spot? MSCI World or FTSE All-World? The names get used almost interchangeably online, and the tickers VWCE, IWDA get thrown around like they mean the same thing. They don't. The difference is small on a fact sheet and large over 30 years. Let's settle it properly. Here's the appeal in one sentence. A single global ETF can hold thousands of companies across dozens of countries and every major sector in one click for one small yearly fee. You buy once, you never manually rebalance, and the index does the diversifying for you. The real question isn't whether to go global, that part is settled. It's just how wide you want that net cast. Three contenders show up in almost every comparison thread. The S&P 500 is 500 large US companies, a US index wearing a global reputation it hasn't earned. The MSCI World holds about 1,300 companies across 23 developed countries. The US, but also Japan, the UK, Germany, Switzerland and more. The FTSE All-World goes widest of the three, roughly 3,760 companies across 49 countries, developed and emerging combined. On paper, more countries sounds like more diversification. Whether it actually behaves that way is the real question. But here's what most beginners miss when they hear global diversification. All three of these funds lean heavily on America because they're weighted by market capitalization, not by country headcount. The S&P 500 is, by definition, 100% US. The MSCI World is about 72% US, roughly America's share of developed market company value. Even the fund with All World in its name is still around 65% US. If you already hold individual US tech stocks alongside one of these funds, you may be far more concentrated in America than you think. So what's the real difference between the two indexes? The MSCI World covers developed markets only. The US, Japan, the UK, Germany, France, Canada, Australia and a handful of others. No China, no India, no Brazil, no Taiwan. It's the simpler, slightly more concentrated bet. You're trusting that the world's already rich economies keep compounding, and you're happy to skip the extra volatility that comes with emerging markets. The FTSE All-World starts from that same developed market base and adds emerging markets on top, roughly a tenth of the fund in places like China, India, Taiwan and Brazil. More countries, more companies and a little less concentration in any single region. It's the closer of the two to owning literally the entire investable stock market in one ticker. That emerging market slice, about 10% of the fund, is the single biggest practical difference between the two indexes. Everything else is a rounding error by comparison. With MSCI World, you're implicitly betting that developed markets keep leading the way they mostly have over the last 15 years. With All World, you're making a different bet, or really refusing to make one. I don't know who wins the next decade, so I'll simply own everyone and let the index sort it out. In raw diversification, All World wins on paper, about 3,760 companies versus roughly 1,300 for MSCI World and 500 for the S&P 500. In practice, both global funds are already plenty diversified. The extra several thousand small companies in All World move the needle only slightly beyond a certain point, even if the ticker count looks dramatically bigger on a slide. What about cost? Basically a tie and cheap either way. A popular FTSE All-World UCITS ETF, Vanguard's VWCE for example, charges about 0.19% a year. A popular MSCI World tracker like iShares IWDA charges about 0.20. That's roughly €2 a year for every €1,000 invested, whichever one you pick. Over a normal investing lifetime, that gap is trivial next to what you already save by not paying for active management. Cost is not the deciding factor here. Over the past several years, the two have performed almost identically, with MSCI World running slightly ahead simply because emerging markets have lagged developed ones for most of this stretch. Here's MSCI World in euros, indexed to 100 at the end of 2019 and tracked through year-end 2025 per the index provider's own fact sheet. It climbs to around 196 by the end of that period. Notice the dip in 2022. That's real, it's normal, and it hit both funds together, not just this one. So recent history clearly favors MSCI World, but recency is a trap every investor falls into eventually. Emerging markets have led for whole decades before, most recently through the 2000s, and there's no law of markets saying developed economies stay ahead forever. Choosing all world isn't a prediction that emerging markets will win the next stretch, it's a refusal to bet that they'll lose. Choosing MSCI World is simply a cleaner, developed world only bet. Neither choice is wrong. They're just different views on a genuinely unknowable question. So here's the practical answer. If you want the single, simplest, broadest, most set it and forget it fund, the one where you never have to think about emerging markets again, FTSE All-World is hard to beat. If you'd rather keep things developed, markets only, slightly more concentrated, and a touch simpler to explain to yourself during a downturn, MSCI World is a perfectly reasonable choice too. What you should not do is buy both. They overlap by more than 90%. So you'd just be paying 2 expense ratios to hold almost the same portfolio twice. Pick one fund, automate the monthly purchase, and stop there. Whichever one you pick, make sure the ticker carries the UCITS label. That's the EU-regulated wrapper, usually domiciled in Ireland, that your European broker can actually sell you, and that keeps the fund's own tax treatment efficient. An accumulating share class reinvests dividends automatically inside the fund, so you don't have to manually reinvest small cash payouts yourself. And in Germany, the Vorabpauschale, an annual advance tax on unrealized gains, applies to both of these funds equally, so it doesn't tip the decision either way. For anything tax-specific to your own situation, talk to a Steuerberater rather than a YouTube video. And here's the mindset point that matters more than either ticker. In 2022, the MSCI World fell about 13% in euro terms, and FTSE All-World fell right alongside it, because a global downturn doesn't spare either index. The investors who kept buying through that dip automatically without checking the news caught the recovery that followed. The ones who panic sold locked in the loss permanently. Whichever index you choose today, how you behave during the next one of these matters far more than which 3-letter ticker you picked. Bottom line, FTSE All-World, the widest net, includes emerging markets about 3,760 companies, 0.19% a year. MSCI World, developed markets only, simpler, about 1,300 companies, 0.20% a year. Both are still roughly 2/3 weighted to the US, both are UCITS eligible, and both have historically fallen and recovered together. Pick one, automate it, and let compounding do the actual work over the next few decades. If this made the choice clearer, the free newsletter linked in the description goes deeper every week. Real numbers, no hype. This was education, not advice. Always do your own research and check your own tax situation before investing. I'm the European investor, and I'll see you in the next one.